Portfolio management, a complete guide. It's fun to pick the stocks and bonds that go into your portfolio, but there is more to it than that. Good portfolio management begins before you pick your first stock. Later, it involves measuring the results of your portfolio management strategy and security picks. A good portfolio management strategy begins by setting goals for the money in your account. Those goals can be anything from saving for a home, retirement, charity, a child's education, or a combination of things. Go ahead and get crazy. It's your money, after all. Once you've decided what you're going to do with your investment portfolio, you'll have a good idea of your time horizon. Your time horizon is like a deadline for your money. If you plan to retire in 20, 30, or 40 years, you can incorporate that time horizon into your portfolio management strategy. Your time horizon can also help you decide how much volatility your account should take. For instance, some securities like stocks typically have higher ups and lower downs than bonds. You have a short time horizon if your time horizon is only a few months or years away. Investors with short time horizons might find stocks too risky. It's not that holding a group of stocks is a risk itself, the risk is that the stocks fall right at the finish line of your goal. Portfolio management strategies. The key to a good portfolio management strategy is asset allocation. Asset allocation goes beyond the stocks, bonds, cash, or other investments you choose to put in your portfolio. It is also the percentage of each asset class you chose. If your time horizon is only a few months, you may choose to put 0% of your money in stocks. Since you have no stocks, you may want to keep your money mostly in cash because it won't fall. Investors with very long time horizons may want a much larger allocation to stocks. With a longer time horizon, investors can tolerate a fall in stocks and benefit from the higher potential return of stocks. Another thing to consider is that the price of your stocks and bonds will fluctuate over time. When that happens, your initial asset allocation can change also. For instance, say you started your account with 75% and 25% bonds. After a year, stocks have done better than bonds, and your portfolio is now 85% stocks and 15% bonds. To keep your asset allocation the way you want, you can sell stocks and buy bonds until your account is back to its intended 75% stock and 25% bond allocation. Investors call this portfolio management strategy rebalancing. Types of portfolio management. When you've picked the right asset allocation for you, the next step is to pick the right investments. You can choose to pick your own stocks and bonds or take a hands-off approach. An active portfolio management strategy allows investors to pick their own investments in stocks and bonds. Investors may choose active portfolio management because they believe they earn a higher return than stock market indexes, or they just like to do it. A passive portfolio management strategy chooses stock and bond investments made to match stock and bond indexes. Index stock or bond mutual funds and ETFs can be an easy way for investors to meet their asset allocation strategy quickly and easily. Keep in mind that a passive strategy will never outperform the market. On the other hand, it will never underperform either. If you like a strategy that can give you the chance to outperform the market without taking the time and effort to pick your own stocks, you're in luck. Professional portfolio managers manage active mutual funds or ETFs that try to outperform their index over time. Diversification. Diversification is the idea that you shouldn't put all your eggs in one basket. For instance, it would not be a good idea for a stock investor to put all their money into one stock. The risk is that the stock does very poorly or, even worse, goes to zero. In that case, it could take years to recover and may put your financial goals in serious jeopardy. Smart investors will diversify their stocks. That way, if a few of their stock picks do poorly, the whole portfolio can still reach its goals. In addition to diversification within stocks, investors may want to diversify across asset classes. Different asset classes like stocks, bonds, and cash are typical. Investors may also hold securities in asset classes like real estate or commodities. You can even diversify within each asset class. For instance, you can hold large, mid, and small cap stocks within your stock allocation. Within your bond allocation, you can have municipal, corporate, treasury, and many other types of bonds. Portfolio returns. Every good portfolio management strategy includes a look at the rate of return of the accounts. There are a few different ways to measure the rate of return. The simplest way to look at the rate of return is the holding period rate of return. This measure does not consider the time that the security or portfolio was held. The formula looks like this. P2, P1 /P1, where P1 equals value at the beginning. P2 equals ending value. Most of the time, rates of return are annualized. That means returns are calculated on a per year basis. If the return period is less than a year, the returns are extended to a yearly basis. This way, securities and portfolios can be compared to each other fairly. Often, investors use the internal rate of return, IRR, to find the annualized rate of return for their investment. The formula for IRR is very complex and not easily calculated by hand. Instead, you can more easily find the IRR of an asset or portfolio with a financial calculator or an Excel spreadsheet. Investors should also think about how taxes on their investments. For example, municipal bonds are typically tax-free. So, comparing the return on a tax-free investment is different. For tax-free investments, investors can find their tax equivalent yield. 2. Reviewing your investment portfolio. Our investment goals and attitude to risk will change over time as we reach different stages in our lives. Leaving your portfolio unchecked for too long is a lot like ignoring the check engine light in your car, you're leaving the outcome to chance. If you want your portfolio to stay on track, like most things, you'll need to make sure it's serviced regularly. We take a look at what you need to think about when it comes to reviewing your portfolio. This article gives you information about how to review your portfolio, but it's not personal advice. If you're not sure what's right for you, ask for financial advice. How often should I review my portfolio? Once you've built your portfolio, it's important to check in on your investments from time to time to make sure they're still right for you. There's no hard and fast rule on how often you need to review your portfolio, but we think twice a year is sensible, once a year at the very least. You should also check in when your circumstances or investment objectives change, or if there have been some big changes in the markets. Reviewing your account once or twice a year should strike the right balance between taking control of your finances and it not becoming a burden or getting in the way of life. Making too many changes to your investments and the possible costs of trading can eat into your returns over the long run. How to review. Take a 6-step approach to reviewing your portfolio. Have your reasons for investing, your circumstances, or your objectives changed? Has your attitude to risk changed? Look at why your investments might have performed differently. Does your portfolio need rebalancing? Check the costs of your investments. Have tax rules or allowances changed? Essentials to reviewing your portfolio. Let's take a look at each step in more detail. Step 1. Have your reasons for investing, your circumstances, or your objectives changed? It's often the case that something happens in your life and you don't instantly think to reflect that change in your investment portfolio. That's why it's important to make it part of your regular review. A change of circumstances that impacts your investment objectives usually falls into one of two camps, those that are expected, and those that aren't, but can still be partially planned for. Expected unexpected retirement job loss, redundancy death change in earned income, either up or down, marriage ill health, personally birth of children ill health dash. Family member buying a house political/market uncertainty. Inheritance investment returns not as expected, either significantly up or down, care costs divorce. The above list is subjective and may differ from person to person depending on their circumstances and views. If there have been any expected or unexpected changes since your last review, then you'll need to think about how that changes the way you need to invest. Whatever changes you choose to make with your investments, it's essential to stick to your long-term plan and avoid making investment decisions based on short-term market movements. Step 2. Has your attitude to risk changed? It's important to review your attitude to risk regularly. That's not because it should change depending on the direction of the stock market, but because the level of risk you're comfortable with could change over time. As you get within touching distance of your long-term goals, like retirement or buying your first house, it's normal to get more nervous about your investments falling in value suddenly. If this resonates with you, it could be a good time to check you are still invested in a way that matches your goals. Step 3. Look at why your investments might have performed differently. Make sure you look at the performance of each investment when you review your portfolio. Not only does this help you understand your own portfolio, but it also helps you to better understand how different stock markets and sectors are performing. Remember, investors aren't worried about what happens to the share or bond price today or tomorrow. We invest for the long term, that's at least 5 years. When you invest in funds, it makes sense to check the performance against its benchmark or sector they invest in. This will allow you to compare the fund's performance against the wider stock market. Remember, there are two types of funds. Actively managed funds aim to outperform the benchmark they're measured against, whereas index tracker funds aim to track a particular index or stock market. Step 4. Does your portfolio need rebalancing? Rebalancing is about restoring the original weightings of the investments in your portfolio. It helps make sure you're matching the level of diversity and risk you planned on when you started out. Suppose you decided to make your portfolio 50% shares and 50% bonds. We're not suggesting this is a good mix, it just keeps things easy for this example. If shares happen to grow at a faster rate than bonds, your portfolio weighting in shares would go above 50%, making your portfolio more risky. You can rebalance by adding any top-ups or redirecting any regular saving instructions to areas which have become underweight. Another way is to sell a portion from your investments that have done well, to top up investments that have performed poorly. It might sound counterproductive, but top performers usually come in waves, and it will help bring the portfolio back into kilter. You can see how and where your money is invested by using the portfolio analysis tool once logged into your HL account. Step 5. Check the costs of your investments. Nobody likes paying over the odds for things, and investments should be no different. As an investor, it's important to check the relative costs of your investments to make sure you're getting good value for money. Think about the cost, quality, and the service provided, things like strategies to avoid losses or income generation. You shouldn't simply chop and change your investments in search of lower costs, because any dealing charges can soon mount up. Just make sure you're aware of any initial charges and the costs of holding your investments. If you do make changes based on costs, only do so when you think you're no longer getting value for money. By checking the costs every year, you're not caught out by any changes to the competitive landscape. Although it's rare for a fund to increase its charges, if other, similar funds now have lower charges, you might decide to make a change, if the new fund looks right for you. Reviewing the costs involved with your investments can also help find any anomalies that don't seem right. For example, two index tracker funds could be tracking the same benchmark, but charging different management fees. Step 6. Have tax rules or allowances changed? Tax treatment and rules that govern our personal finances have a tendency to change over time. It's really important to check any changes that have come in when you review your portfolio. It could mean changing how you invest, particularly which accounts you use to hold your investments, as some will have different tax rules. Thanks for watching. Make sure to like and subscribe.